Listen, I want you to picture something. A Sunday evening in October of 2025. A study in a colonial house in Greenwich, Connecticut. His name is Richard. He is 71 years old. He sold his regional distribution company in 2019 after 34 years of building it from a single warehouse and 3 employees to a 400-person operation with 12 facilities across the Northeast. The sale generated $11,400,000 after taxes. He invested most of it. He kept the house, which is now worth $2,800,000. He has a taxable investment portfolio at Fidelity with $7,200,000. He has a traditional IRA with $1,900,000. He has a life insurance policy with a $3 million death benefit held inside an irrevocable life insurance trust his estate attorney set up in 2021. His total gross estate is approximately $15,100,000. Richard is not anxious about the estate tax. He has not been anxious about the estate tax since 2017, when the Tax Cuts and Jobs Act doubled the federal estate tax exemption to approximately $11,180,000 per individual, indexed for inflation. By 2025, the individual exemption has grown to $13,990,000. Richard and his wife Margaret have a combined exemption of $27,980,000. Their $15,100,000 gross estate is well below the combined exemption, no estate tax. Richard has mentioned this to his estate attorney at their annual meeting every year since 2017. He has said it the way people say things they believe to be permanently settled. The estate attorney has nodded and moved on to other planning topics. On January 1st of 2026, the Tax Cuts and Jobs Act provisions governing the estate tax exemption are scheduled to sunset under the terms of the original legislation. The exemption is supposed to revert to pre-TCJA levels adjusted for inflation, which is approximately $7 million per individual. Under the original sunset, Richard and Margaret's combined exemption would drop from $27,980,000 to approximately $14 million. Their $15,100,000 gross estate would be exposed to the 40% federal estate tax on approximately $1,100,000 of taxable estate. The federal estate tax bill, approximately $440,000. Richard does not know this because his estate attorney did not surface it as an urgent planning item. The attorney knew about the sunset. The attorney mentioned it in passing at the 2024 annual meeting. Richard did not hear it as a crisis requiring immediate action because the attorney did not present it as a crisis requiring immediate action. Now it is October of 2025, and Richard is sitting in his study because his accountant called on Friday and asked whether his estate plan had been updated to address the potential exemption change. And Richard is realizing that the answer is no, and that January 1st is 11 weeks away. Now, here is what actually happened. Congress passed the One Big Beautiful Bill in 2025, which extended the TCJA estate tax provisions and raised the individual exemption to $15 million, indexed for inflation. The sunset that Richard feared did not occur as originally scheduled. The exemption did not revert. The estate tax did not change in the way the original TCJA sunset would have produced. Richard's $15,100,000 gross estate remains within the combined exemption of $30 million for married couples under the new law. No estate tax for Richard and Margaret. But here is the critical lesson that Richard's near miss teaches, and that is the actual subject of this video. The estate tax exemption is not permanent. It has never been permanent. It was temporarily doubled by the TCJA in 2017. It was extended and increased by subsequent legislation in 2025. It is subject to future congressional action at any time. The next significant tax legislation in 2029, 2031, 2033, or whenever the political winds shift, could reduce the exemption again. Could reduce it dramatically. Could reduce it without a phase-in period. Could reduce it with an effective date that gives families 6 months or 6 weeks to respond. And the families with estates between $7 million and $30 million, the upper middle class and the moderately wealthy who are not billionaires, but who have built meaningful wealth through decades of business ownership, real estate appreciation, investment compounding, and life insurance accumulation. Those families are the ones who sit directly in the exposure zone every time the exemption discussion moves to the congressional floor. Richard's 11-week near miss in October of 2025 is the template for what happens when a family with a meaningful estate assumes the tax code is stable and does not maintain current exemption-aware estate planning. The 4 assets that needed to move before the exemption dropped, whether in January of 2026 or in whatever future year the next exemption reduction takes effect, are the same 4 assets in every estate of this type. And moving them requires understanding the gifting strategies, the trust structures, and the valuation techniques that allow families to transfer wealth out of the taxable estate at current exemption levels before a future reduction captures that wealth at 40 cents on the dollar. That is what we are covering today. Smash the like button right now. Estate tax planning content is systematically suppressed by the algorithm because it is perceived as content for the wealthy, and the platform deprioritizes content that serves a narrower demographic. But the estate tax exemption affects every family whose combined assets have crossed or are approaching the individual exemption threshold through 3 decades of real estate appreciation, retirement account compounding, life insurance accumulation, and business value. Through 3 decades of real estate appreciation, retirement account compounding, life insurance accumulation, and business value. That family is not a billionaire family. That family is a family like Richard's. Every like breaks the suppression. Hit it, subscribe, flip the bell. The suits and legal want me to say this is not legal or financial advice. Fine, this is not legal or financial advice. This is a forensic examination of the federal estate tax structure, the gifting provisions of the Internal Revenue Code, and the 4 asset categories most commonly targeted for pre-exemption reduction transfer planning. Consult an estate attorney and a fee-only fiduciary who practices in this area. What I can do is show you the mechanism and the math. Let me start with the statutory foundation. The federal estate tax is imposed under Internal Revenue Code Chapter 11 on the transfer of the taxable estate of every decedent who is a citizen or resident of the United States. The tax rate is 40% on the taxable estate, which is the gross estate minus allowable deductions minus the applicable exclusion amount. The applicable exclusion amount is the lifetime gift and estate tax exemption. Under current law, following the One Big Beautiful Bill of 2025, the individual exemption is $15 million, indexed for inflation, and the married couple's combined exemption is $30 million through portability. Portability allows a surviving spouse to use the deceased spouse's unused exemption, called the deceased spousal unused exclusion, as long as a timely estate tax return is filed for the first-to-die spouse, even if no tax is owed. The gift tax and the estate tax are unified. The lifetime exemption covers both lifetime gifts and assets transferred at death. A gift of $2 million made during life reduces the estate tax exemption available at death by $2 million. The annual gift tax exclusion, currently $19,000 per recipient in 2026, is separate from the lifetime exemption. Annual gifts up to $19,000 per recipient do not reduce the lifetime exemption and are not reported on a gift tax return. A married couple can gift $38,000 per recipient per year through gift splitting without using any lifetime exemption. Now let me name the 4 assets most commonly transferred out of the taxable estate before an exemption reduction and show you what each transfer accomplishes and how it is executed. Asset 1. The appreciated taxable investment portfolio. Richard has $7,200,000 in a taxable portfolio at Fidelity. This portfolio has substantial embedded capital gains from decades of compounding. Under current law, with the $15 million individual exemption, this portfolio is inside the combined exemption and not subject to estate tax. But if the exemption were reduced in a future legislative cycle, a portion of this portfolio could become exposed to the 40% estate tax rate. The primary tool for transferring the investment portfolio out of the taxable estate while preserving the income stream it generates is the Spousal Lifetime Access Trust, the SLAT. A SLAT is an irrevocable trust funded by the grantor spouse that benefits the other spouse during their lifetime and transfers the trust assets to the children or other beneficiaries at the beneficiary spouse's death. The grantor transfers assets into the SLAT using lifetime gift tax exemption. The transferred assets are removed from the grantor's taxable estate. The income and principal distributions from the SLAT benefit the beneficiary spouse during their lifetime, providing the couple with indirect access to the trust assets through the beneficiary spouse. The transfer to the SLAT uses lifetime exemption at the current rate, which is $15 million per individual under current law. If Richard transfers $3 million of the investment portfolio into a SLAT for Margaret's benefit today, that $3 million is removed from his taxable estate permanently. The assets grow inside the SLAT outside his estate. The future appreciation on those assets is also outside his estate. If the exemption is later reduced to $7 million, and the $3 million that was gifted to the SLAT would now represent excess above the lower exemption, it does not matter. The transfer occurred at the higher exemption level and is locked in. The IRS confirmed in Treasury Regulations Section 20.2010-1C that gifts made under a higher exemption are not clawed back if the exemption is later reduced. The clawback protection means that transfers made now at the $15 million exemption level are permanently outside the estate, even if the exemption drops below the transfer amount in future years. This is the use it or lose it principle of estate tax planning. The exemption available today is worth more than the exemption available after a future reduction, because the transfers made today are permanently locked at the current exemption level. Asset 2. The primary residence or real estate holdings above the annual exclusion threshold. Richard's $2,800,000 Greenwich house is a significant estate asset. The house is also potentially undervalued for estate tax purposes because real estate that is part of a family's primary residence may qualify for certain valuation discounts in specific structures. The tool for removing real estate from the estate while retaining the right to live in it is the Qualified Personal Residence Trust, the QPRT. A QPRT is an irrevocable trust into which the grantor transfers the residence while retaining the right to live in the home rent-free for a specified term of years. At the end of the term, the home passes to the named beneficiaries, typically the children, and the grantor no longer owns it. The gift made at the time of the QPRT transfer is valued at a discount to the full fair market value of the property. The discount reflects the value of the retained income interest, meaning the right to live in the home for the term years. Using current IRS Section 7,520 rates to calculate the present value of the retained interest, the taxable gift for a $2,800,000 house in a 10-year QPRT might be valued at approximately $1,600,000 to $1,900,000 rather than the full $2,800,000. Richard uses $1,700,000 of lifetime exemption to transfer a $2,800,000 house. The $1,100,000 difference is the discount achieved through the QPRT structure. If the house appreciates to $3,500,000 by the time the QPRT term ends, the full $3,500,000 passes to the children outside Richard's estate. Richard used $1,700,000 of exemption to remove a $3,500,000 asset from the estate. The QPRT has a risk. If Richard dies during the term years, the house is pulled back into his estate as if the trust never existed. The term should be set at a length Richard is reasonably confident he will survive. For a 71-year-old in good health, a 5 to 7 year term is appropriate. A 10-year term carries more mortality risk. Tell me in the comments right now. Tell me the approximate value of your gross estate, including home, investment accounts, retirement accounts, business interests, and life insurance. Tell me your state of residence. Tell me whether your estate attorney has discussed the current exemption level and any potential future changes with you in the last 12 months. Drop it in the comments. I read every single one. We assess the exemption exposure together. Asset 3, the closely held business interest. Richard sold his business in 2019, but for the business owner who has not yet sold, the business interest is often the largest asset in the estate and the one with the greatest estate tax planning leverage, because closely held business interests qualify for valuation discounts that reduce the taxable value of the gift below the fair market value. A 30% ownership interest in a closely held business might be worth $3 million on a proportional basis, meaning 30% of a business valued at $10 million. But a minority interest in a closely held business, one without controlling power and subject to restrictions on transferability, is not worth the same as a 30% cash equivalent. A qualified business appraiser applying a minority interest discount and a marketability discount can credibly value that 30% interest at $1,800,000 to $2,100,000 rather than $3 million. The $900,000 differential passes outside the estate using only $2,100,000 of exemption rather than $3 million. A business owner who gifts $2,100,000 of appraised discounted value out of the estate has transferred $3 million of proportional economic value. Multiply this leverage across a $10 million to $20 million business, and the valuation discount strategy can transfer millions of dollars of value outside the estate using a fraction of the exemption that would be required for a straight gift of the same economic value. And the valuation discount strategy can transfer millions of dollars of value outside the estate using a fraction of the exemption that would be required for a straight gift of the same economic value. The structures used to hold the business interest before gifting, the family limited partnership and the family limited liability company, provide the structural basis for the minority interest and marketability discounts. The FLP or FLLC holds the business assets. The senior generation holds the general partner or managing member interest, and the limited partner or non-managing member interests. Gifts of the limited partner interests carry the discounts. The senior generation retains control through the general partner position. The structure must be established and funded with legitimate non-tax business purposes, properly administered with capital accounts, annual meetings, and arm's-length transactions to survive IRS scrutiny. Asset 4. The life insurance policy held outside the irrevocable life insurance trust. Richard's $3 million life insurance policy is held inside an irrevocable life insurance trust established in 2021. The ILIT is correct. The policy is outside his estate. The death benefit passes income tax-free to the trust beneficiaries outside the probate estate and outside the taxable estate. But many estates contain life insurance policies that are owned individually rather than inside an ILIT, either because the ILIT was never established or because the policies were acquired after the ILIT was established and were not transferred into it. A life insurance policy owned by the insured is included in the gross estate under Internal Revenue Code Section 2042. A $2 million term policy owned by the insured with children as beneficiaries is a $2 million estate asset. A $2 million permanent policy with cash value owned by the insured is also a $2 million estate asset plus the cash value. The fix for a policy owned outside an ILIT has two forms. Transfer the existing policy to a newly established ILIT and survive for 3 years after the transfer. If the insured dies within 3 years of the transfer, the policy proceeds are pulled back into the estate under Section 2035's 3-year rule. The 3-year risk is the cost of the transfer strategy. For younger or healthier insureds, the 3-year survival probability is high and the transfer strategy is sound. For older or less healthy insureds, where the 3-year risk is meaningful, the alternative is to have the ILIT purchase a new policy directly from the insurance company rather than accepting a transferred policy. A policy purchased by the ILIT on the insured's life is never owned by the insured and therefore never enters the estate under Section 2042. No 3-year rule applies. The ILIT funds the premiums through annual gifts from the grantor. The crummy power provision in the ILIT gives beneficiaries a temporary right to withdraw gifts made to the trust, which qualifies the gifts for the annual exclusion. Up to $19,000 per beneficiary per year in 2026 can be gifted to the ILIT annually without using lifetime exemption, funded as premium payments for the estate-excluded policy. Let me now give you the geographic dimension. The federal estate tax is uniform, but state estate taxes create additional exposure in states that impose their own estate tax at lower exemption thresholds. Connecticut, where Richard lives, imposes a state estate tax with an exemption of approximately $13,610,000 per individual in 2026, indexed to track the federal exemption under current Connecticut law. For most Connecticut estates below the federal exemption, the Connecticut state estate tax does not create additional exposure beyond the federal. But in other states, the state exemption is dramatically lower than the federal. Massachusetts imposes a state estate tax with an exemption of $2 million per individual. A Massachusetts estate of $3 million owes Massachusetts estate tax on the excess above $2 million at marginal rates up to 16%. Oregon imposes a state estate tax with an exemption of $1 million per individual, one of the lowest in the country. An Oregon estate of $2 million owes Oregon estate tax on $1 million at rates reaching 16%. Washington state imposes a state estate tax with an exemption of $2,193,000 per individual in 2026. Estates above this threshold in Washington owe state estate tax at rates reaching 20%. The state estate tax implications mean that families in Massachusetts, Oregon, Washington, Maryland, Illinois, Minnesota, and other states with separate state estate taxes face exemption exposure at much lower asset levels than the federal $15 million threshold. A Massachusetts family with $4 million in total assets, a paid-off house worth $1,200,000, a brokerage account with $1,500,000, a retirement account with $900,000, and a life insurance policy with $400,000, owes Massachusetts estate tax on the $2 million above the $2 million Massachusetts exemption, even though the entire estate is far below the federal exemption. The planning tools for the state estate tax are the same as for the federal tax, but apply at lower asset thresholds. A Massachusetts family should be thinking about the SLAT, the QPRT, and the ILIT at $3 million of total assets rather than $15 million. Now let me give you the 5-step action sequence. What families with estates approaching or above the current federal exemption or any applicable state exemption are doing right now to protect against a future exemption reduction. Step 1. Calculate the current gross estate comprehensively. Add the fair market value of all real estate, all investment accounts, all retirement accounts, even though they are income taxable rather than estate taxable in most cases, all life insurance death benefits owned by the insured, all business interests, and all other assets. The retirement accounts are included in the gross estate because they are assets of the decedent, even though they carry their own income tax liability when distributed. The estate tax and the income tax on retirement accounts are separate issues, and both must be included in the gross estate calculation. Step 2. Compare the gross estate to the current exemption level and to the exemption level that would apply if the exemption were reduced in a future legislative cycle. For the federal tax, model the estate at both the current $15 million individual exemption and at a reduced $7 million individual exemption to understand the exposure if a future Congress acts to lower the threshold. For the state tax, identify whether your state imposes a separate estate tax and at what exemption level. Step 3. Identify the assets most suitable for pre-exemption reduction transfer. The 4 assets described in this video are the primary candidates: the taxable investment portfolio for the SLAT, the primary residence or real estate for the QPRT, the business interests for the FLP or FLLC structure with valuation discounts, the life insurance policy for the ILIT transfer or new ILIT purchased policy. Step 4. Engage an estate attorney who specializes in wealth transfer planning to design the transfer structures. The SLAT, QPRT, FLP, and ILIT are sophisticated instruments that require precise drafting to achieve their intended tax results and to withstand IRS scrutiny. A generalist estate attorney who primarily drafts wills and simple trusts is not the right advisor for this work. Seek a board-certified estate planning specialist or an attorney with a demonstrated practice in irrevocable trust structures and business interest gifting. Step 5. Execute the transfers during the current high exemption window. The transfers made now at the $15 million exemption level are locked in permanently under the clawback protection regulations. Every month of delay is a month during which an unexpected health event, a market decline, or a legislative change could narrow the window. The exemption does not wait for a convenient planning timeline. Save this video to your private library right now. Hit the bookmark. Add it to the estate survival playlist. Because the estate tax exemption is the most politically unstable provision in the entire federal tax code, it has been raised, lowered, eliminated, restored, doubled, and extended through 11 major pieces of legislation since 1997. The current $15 million level is not a permanent feature of the tax system. It is the current legislative outcome of a political process that has produced 9 different exemption levels in the last 28 years. Richard's near miss in October of 2025 was resolved by legislation. The next near miss may not be resolved by legislation. The next near miss may be the real event. Subscribe if you have not. Flip the bell. Subscribe if you have not. Flip the bell. Comment with the approximate value of your gross estate and your state. Tell me whether your estate plan has been reviewed in the last 12 months for exemption level relevance. We assess the exposure together in the comments section. I read everything. The 4 assets are transferable now. The exemption is available now. The clawback protection exists now. The 3-year term on any QPRT you establish is running now. The ILIT you fund today is outside the estate today. The SLAT you fund this year removes those assets from the taxable estate permanently, regardless of what Congress does to the exemption in 2029 or 2031 or 2033. Use the window. The window is open. I will see you in the next one. Stay strategic. Stay furious. The estate tax exemption was designed to change. Plan accordingly.